Good afternoon, everyone, and good morning to those of you joining us on the West Coast today. Segal would like to welcome you to today's presentation, Segal Select's Annual Insurance and Benchmarking Update, 2012, a look back, 2013, a look forward. And now I'd like to introduce our speakers. We have Mark Dobro, Vice President, Matt Jackson, Vice President, and Brian Smith, who is our Chief Operating Officer. Now I'll turn the call over to Brian.
Thank you, Liza, and welcome everyone, and thank you for joining us this afternoon. In this look back and look forward, we're now going to concentrate on our four core products. We've expanded from just fiduciary liability and the fidelity bond to also include the employment practice liability and cyber liability, starting with fiduciary, which is our core product and always has been. 2012 proved to be really interesting. If you participated in our webinar in December, I think we were indicating on the first slice we thought the market had actually gone down for the 8th year in a row. As we looked at the data and reanalyzed it and did some checking on the way our data was compiling itself, we've actually determined in our database that the average rate per million, so how much does a client pay for each $1 million of coverage? And we just take this as a composite. So of all the accounts, we add up all the limits of liability, all the premiums, and calculate what is the average per million. We're finding it actually this year went up about 3.4%. So it finally ends what we might call a soft market, at least at one level it does. But if you look at these next couple of slides we're going to do.
Brian, before we move on, if I could ask, why do you think there was a market increase? Typically trustees always ask that question. They haven't had any claims. They're wondering why they would be experiencing the premium increase.
The reality, Mark, is the claims have been going up. And it's one of the things that was confusing us throughout 2012 for a period of time now, and I think it goes back more than just 2012. It's dipping back into 2011 and maybe even a little bit into 2010. We've been seeing more and more claims being reported. So certainly the frequency has been going up. And unfortunately, we've been seeing more severity in claims. I know in our book of business with our carriers, the amount of loss payments they're making have increased dramatically in 2012. And for a lot of our clients, it's really the adage of the insurance policy, the many pay for the few. It only takes one insured, and they can blow through $3, $5, $10 million. And for a lot of our carriers, you start to get to that $5 or $10 million category, and that really starts to impact their loss ratios on their overall book of business. So it doesn't take a lot to really change the results for the carriers on this particular product line. Let's take a look at saying they went up on average, but let's look at more specifically. We found this slide fascinating, interesting, confusing. This is the average premium and the change in the average premium among these different peer groups that are along the horizontal axis. So if you look right in the middle where it says equals 5 million, in 2012, which is the darker color, we're saying the average premium decreased by 2.65%. And if you look across the scope of this graph, most of the premiums decreased. There's only one real exception, and that's for those buying equal to or greater than 20 million. So the capacity, the large clients, those buying very, very large limits, we saw average premiums go up. But what really was confusing us on this, if we go back to that prior slide, we said the average rate only went up 3.4%, the average rate per million, but the average premium went up 31%. How does that happen? And on this one, we did look at this and try to. These are a fairly small group of clients. There's not that many who buy these really large limits, and maybe a couple of dozen or so, maybe 3 dozen. I don't remember the exact number. There were new clients that came in that we picked up during the year, and their premiums might have been a different structure than what we've seen on clients that we've been handling for several years. We're seeing a lot of issues going on here that there may be other variables, other factors that put a nuance that you can't just look at this and say that it went up 31%. There's other things going on that make up what that 31% consists of. But this slide also shows that the market has remained, for most of our client base, very competitive. And I think the next slide is going to say the same thing. If we look at the average limits, it seems to be saying in 2012 the average limits decreased. I said Mark and Matt were going to ask questions of me. I'm going to flip around and ask a quick question of them. How many of our clients literally of our renewal clients literally reduced their limits of liability on renewal?
None that I can think of, actually.
Mark, can you think of any?
I can't recall a single one.